We see the market headlines flash across our screens every single day, but have you ever really stopped to ask what a stock exchange is? I mean, at its core, we know it's the engine of our economy, but what's its fundamental purpose? Let's dig into the indispensable why behind this system we all, in one way or another, depend on.
So yeah, that's the big question, isn't it? Why do we even have these things? It seems simple, but the answer is pretty much the key to understanding our entire modern economy. And to find that answer, we actually have to go back in time and imagine a world that didn't have them.
You see, to really get why stock exchanges are so vital, we need a little perspective. Before these organized, regulated centers existed, the financial world was, for lack of a better term, the Wild West. It was pure chaos, full of secrets, and almost completely lacking in trust. This timeline isn't just a list of dates, it's a story of things going wrong over and over again. For more than a century, economies were just slammed by one financial crisis after another. The freewheeling, anything-goes attitude of the 1920s led straight to the Great Crash of 1929. And that disaster was made so much worse because nobody really knew what companies were doing. It was all secret. That crash was the final straw. Something had to change, fundamentally.
And so, out of that rubble, the modern stock exchange was really born. Now, this wasn't some happy accident. It was a deliberate invention, a system engineered from the ground up to solve the exact problem of chaos that we just saw.
And its mission was beautifully simple: replace all that chaos with some actual order. The whole goal was to create one central place to do business, a place built on three pillars: transparency, rules, and liquidity. That's just the ability to easily buy and sell. This was the blueprint for building trust into a system that had absolutely none.
This chart just makes it crystal clear. On the one hand, in a centralized exchange, you've got a transparent public auction where everyone sees the price and the rules guarantee the trade. On the other hand, you have the old way, opaque, backroom deals with zero oversight and no guarantee you could actually sell your investment when you needed to. The exchange wasn't just a small improvement, it was a total revolution in how you create trust.
But look, creating trust wasn't the final goal. It was the foundation. Because once you have a system people can actually trust, you can build something truly powerful on top of it, a real engine for economic growth. So how does it actually fuel the economy? It's through this process called capital mobilization. I know, it sounds like a boring textbook term, but it's actually a really cool and vital idea. The stock market takes the savings from millions of different people and channels that money directly to companies that have big ideas. That cash is the fuel that lets businesses build new factories, invent new technologies, and ultimately create jobs.
And this is where the genius of the system really shines. So, in step one, a company goes public with an IPO to raise a bunch of money for the first time. But that only works because of step two, the secondary market. You know, the exchange, where investors know they can easily trade those shares later. I mean, think about it. Would you ever buy a share in a company if you knew you could never, ever sell it? Of course not. This creates this incredibly powerful confidence loop. The secondary market is what makes the primary market possible. One can't work without the other. And this quote just nails that point. Illiquidity, basically being stuck with something you can't sell, is a massive reason people don't invest. If you can't get your money out easily, you're not going to be eager to put it in. That guarantee of an easy exit, that liquidity, is the absolute bedrock that the whole system is built on.
Okay, so the exchange helps fund companies, but it performs another, equally critical function. In a way, it acts as a giant, real-time truth machine for the entire economy.
This amazing process is called price discovery. It's not one expert sitting in a room deciding what a company is worth. It's millions of buyers and sellers all over the world acting on all the information they have and constantly voting with their wallets. The price that comes out of that process is the best, most reliable consensus we have on a company's true value at any given moment.
And when you zoom out, the entire market becomes this essential economic barometer. When you look at an index like the S&P 500, you're not just seeing numbers go up or down. You're getting a real-time snapshot of the collective health and confidence in the economy. It's a vital sign that everyone from policymakers to CEOs watches constantly.
But this isn't just abstract information floating around. The market sends very clear signals that drive real-world action. And one of the most powerful signals is a concept called Tobin's Q.
So what on earth does that mean? Well, in practice, it's pretty straightforward. When a company's value on the stock market is higher than what it would cost to replace all its stuff, its factories, its computers, everything, The market is sending a loud and clear message to the people in charge. We believe in what you're doing. We think your ideas are worth more than your assets, so take our capital and go build more. It's a direct incentive to invest, expand, and grow.
But, of course, let's be real. No system this big and this powerful is ever going to be perfect. The very things that make the stock exchange so essential, its speed, its scale, also create their own unique challenges and trade-offs. There are two main risks that are just baked into the system. First, all that high speed and high visibility can sometimes fuel speculative bubbles, when prices get totally disconnected from reality. And second, there's the criticism of short-termism. This idea that the constant pressure of the daily stock price forces executives to focus only on the next 3 months instead of the next decade.
But this debate about short-termism is fascinating because the evidence is really complex. The critique is simple, right? The pressure of the market makes managers chase quick wins instead of investing in long-term R&D. And yet, how do you explain the trillion-dollar valuations of major tech companies? The very existence of those valuations proves the market is capable of seeing and pricing in potential growth decades down the road. It's a real tension at the heart of the system.
So, when you strip it all away, what is the stock exchange? It's not a casino, it's not a betting parlor, it is essential infrastructure. It's the central nervous system of modern capitalism, a regulated public utility designed for one primary purpose: to create the trust that's required to turn savings into economic growth.
It's an incredible, though definitely imperfect machine. It was invented to solve the defining financial problems of the 20th century: chaos, secrecy, and a deep lack of trust. And that leaves us with one final big question to think about. What are the defining problems of our century, and what new system will we have to invent to solve them?